Hey nerds and nerdettes, in today's video I'll be revealing my portfolio of stocks, 36 of which pay a dividend, totaling a truly passive income stream of $760 per month. I'll show you my income calendar of when these dividends actually get paid out. I'll show you future income projections, pros and cons of individual stocks, specifically dividend stocks, and some reasons why people are against dividend investing in the first place. Before we get started, just a reminder, I am not a financial advisor and this is not personalized financial advice. This is just my personal experience, and obviously your experience might vary. Let's get into it. Okay, so just a quick definition of what dividends even are in the first place. If you're not familiar, dividends are simply a distribution of profits that are paid back out to investors. So if companies aren't using excess profits or money that they're generating from their business to invest back into the business, or they're not using it to buy other companies to consolidate, they can return these profits or these revenues back to you, to the shareholder, in the form of a dividend. So let's get into my dividend portfolio. I'm going to be using a service that's called SimpliSafe Dividends. So if we look at this overview, the thing I like about this is that it consolidates all your portfolios into one clean dashboard. You can see here that the current balance at the time of this recording is just under $500,000. And keep in mind, this video is not meant to be like a flex or a brag or anything like that. It's just simply meant to show you what's possible if you invest slow and steady over the long term. Some of these portfolios are a couple years old, some are about 15 to 20 years old, depending on which ones you're looking at. So right now, the annual income you can see right here is $9,124 with an overall dividend yield of 2.05%. And then we have things like yield on cost and beta, which I can get into later. So although almost every position in this portfolio pays a dividend, they aren't all necessarily dividend-focused stocks, okay? A lot of my portfolio is actually in Vanguard's VTI, which is essentially a diversified ETF of U.S. companies focusing on growth and value styles. So if you don't know what an ETF is, it just stands for Exchange Traded Fund. Think of this as like an Easter basket full of Easter eggs, and those Easter eggs are individual stocks, but the ETF trades just like one stock. So let's get into the income calendar and income projections so you can see what's possible with dividend investing. Okay, so if we check out the income calendar here, this will actually show you when your entire portfolio is paying out dividends. And I'll actually go to the year view just because a lot of the quarter is over and a lot of my stocks have already paid me dividends. So I'll just show you what this looks like on an annual basis, and we can break down each individual one down here. So if I zoom in here, you can see that the total is $9,124 per year, which comes out to be right around $760 and some change per month. So you can see here that a dividend is paid every single month. You can see $44, $44, $46, for example, but the big bars are typically every 3 months. This is paid out on a quarterly basis. Some take 4 months to pay out every once in a while, but typically the majority of this portfolio is paid out quarterly, and then one of these is actually annually, which I'll show you here in a second. So you can see here that every time I'm paid out, I actually have what's called a DRIP plan enabled. DRIP just stands for Dividend Reinvestment Plan. This means that instead of realizing that income or getting that income paid out to me, you just take what the dividend would be and buy more shares of whatever that stock is. So you're typically compounding over a long period of time, and that's going to affect your yield on cost, which I can explain here in a second. So if I sort this by highest to lowest, you can actually see that since the majority of my portfolio is made up of VTI over here, you can see that this is actually my highest paying dividend ETF that I hold. So VTI isn't specifically a dividend ETF, which I talked about earlier, but no matter what, $2,600 of these dividends are getting plowed back into VTI to buy more, and this is when that dividend snowball really starts. Think of it like a small snowball going down the hill, and it gets bigger and bigger and bigger as it attracts more snow, aka more shares. So the second biggest one is SCHD. This is actually Schwab's dividend equity ETF, and this is yielding 3.54%. So I'm going to jump into dividend yield here in a second, but I actually want to show you just the rest of this portfolio. So you can see VXUS, AVUV, VYM, VNQ, and then all these smaller positions are individual stocks, which are paying out a dividend themselves. And you can see when I actually get to the bottom here, every quarter is about $1,600. This target date fund actually pays out once a year, so this is actually December right here where it says $3,300. But basically, for the gist of it, all these numbers add up to that $9,100 number per year. Now, if I actually go back to the portfolio and click on income forecast, this is a pretty neat tool that'll actually show you or predict what your income or your dividend income should be per year by growth, assuming a few things. So this is assuming 6.5% per year of dividend growth. So this is the companies that are actually raising their dividends. And this is important because the company, depending on what kind of dividend investor you are, if you're a dividend growth investor, you really should be focusing on stocks or dividend companies or dividend ETFs that grow their dividend yield by more than the inflation rate, right? So if the inflation rate is 3% and your dividend growth is 2%, well, then your dividend didn't even keep up with inflation. Yes, you have to also account for the appreciation of the actual equity itself, meaning the price of the stock. So between the price of the stock and the dividend growth, that should be coming out higher than inflation. That means you're actually increasing your wealth and increasing your purchasing power. If those two metrics are at or below inflation, you're actually losing money you're actually losing purchasing power in the future, right? So anyway, that's assuming 6.5% growth per year based on my portfolio, the 5-year dividend growth rate. This is actually reinvesting the dividends. That's where that 3% boost is coming from. And then also this is considering me contributing $1,000 per month or $12,000 per year. So this is what happens in this scenario. I think it's pretty cool. So if you're patient and you're able to save $1,000 a month in this example, you don't have to do this, but it does help. Even assuming a 7% per year growth rate, 20 years from now, I'll have an income stream of $45,300 based on these metrics. If this portfolio appreciates or grows at a rate of 9.5% per year, 20 years from now, I'll have a $70,000 income stream where I can live off $70,000 per year. I don't know about you guys, but I live in a low cost of living part of the country. $70,000 per year, if it's inflation adjusted in 2024 dollars, I can easily live off that stream of income, and I never have to touch the underlying principal, meaning I don't have to sell any of this dividend portfolio or my portfolio in general. So this is pretty interesting. If you want to take more time, pause the screen here, or you can play with these projections as well in a mock portfolio, and you can really see how this portfolio grows over 10, 20, 30 years. So at this point in the video, I did want to show you some of the performance of these individual stocks, but I also want to talk about the pros and cons of individual stocks. In my opinion, a majority of my portfolio is actually invested in ETFs and index funds, and this may actually be a better bet than individual stocks. You'll see exactly why here in a second. So if I scroll down, I can zoom out so you can see the whole portfolio. Let's actually sort this by gain or loss. So if I actually sort this by gain or loss, I'm going to zoom in here. You can see some of these positions are up 90%, 75%, 48%, 45%. This is incredible, right? High yield savings accounts at the time of this recording are getting somewhere in the neighborhood of 5% returns. However, if you go to the flip side of the portfolio and actually scroll down, you can also see the biggest losers. Luckily, the biggest loser is only 48%, 42%, 25%, 21%, right? This is the problem with individual stocks. And all of these that have the highest gains and the biggest losses are typically individual stocks. You can see the biggest loser right here. Well, don't consider GameStop. Sorry, that was just bought for fun. But if you look at the ones that are in my dividend portfolio, you have Leggett and Platt, you have UGI, Hormel Foods, Verizon, Medtronic, and Pfizer. If you look at all the ETFs that have actually just done pretty solid, I'm actually going to sort my portfolio by percentage of portfolio, meaning it's my biggest holding. My biggest holding by and far away is VTI, and you can see what it's done. It's a solid 11.8%, and this was only started investing in about 2.5 years ago. So imagine if I held VTI for a longer period of time. Now, what I want to give you an example of is if you look at individual dividend stocks, you can really get enticed by chasing yield or the allure of passive income, right? So what I say by chasing yield is we talked about the dividend yield earlier. So if you want to get a quick example, let me just use SCHD as an example. SCHD is right here. It yields about 3.5% per year, okay? So if I were to put $1 million into SCHD today, I would expect a $35,400 stream of income, right? If you did $100,000, you could expect $3,540. If you did $10,000, you can do the math, right? It's pretty simple. So the thing with dividend stocks is people get enticed by chasing yield to where they completely forget about growth. So if you want to know how to figure out dividend yield, basically you take the dividends per share divided by the current share price. So for example, if a company is trading at $10 for easy numbers in the market and it issues an annual dividend per share of $1, meaning that for every share you hold, it's $1, you can divide those two numbers and you'll get a dividend yield of 10%. It's 1 divided by 10. So when you start to get to such high yields, those can actually be somewhat unsafe because these are typically companies that are living off that dividend yield and kind of marketing themselves as dividend stocks. But if you actually look at the price of the stock itself, no bueno, right? Your value, your principal is actually getting destroyed in the long term. So what are you giving up, right? You're giving up significant growth, actually capital destruction, not capital appreciation, but capital destruction, just to receive that dividend, right? So let's take a look at these two charts. This is a famous dividend payer. This is a company called Realty Income Corp, ticker symbol O, and they're famous for paying out dividends consistently, raising their dividends consistently, right? But if you look at a 5-year chart, O is actually down 13.4%, okay? So if you had, let's say, $1 million in this company, you're now down $134,300 in principal. Yes, you've been receiving dividends that whole time, but the dividend yield, as you can see here, is 5.3%. And over the past 5 years, the destruction of capital has been 13.43%. Okay. Now, if we compare that to something that I'm heavily invested in, like a VTI, you can see here the past 5 years, VTI has actually appreciated 75.12%, and this actually still pays out a dividend. If I actually go to my portfolio here and look at VTI, you can see that VTI is actually still paying out a 1.4% dividend. Yes, it's not a high dividend. Yes, it's below what you can get in a high yield savings account today. And yes, it's below the rate of inflation. However, the growth has been incredible just over the past 5 years, right? So you have to weigh the pros and cons of chasing yields. Okay, so let's talk about some people's argument against investing in dividends or being a dividend investor in general. So their case comes down to a couple different things. I'll just give you the general overview. There's more nuances and details, but these are the two biggest ones. So in a nutshell, receiving a dividend as a shareholder is the same as selling a portion of the stock. So the stock price drops by the dividend payment amount on the ex-dividend date. So for example, if a stock is trading at $50 per share and it pays a $2 dividend, that stock price is going to go to $48, right? So what this does is it also creates a taxable event. So if this isn't sitting in a tax advantage portfolio, say for example, like a Roth IRA, for example, where all your growth is tax-free, you're creating an unwanted taxable event. So there's a couple different ways to look at dividends. There's qualified dividends and there's non-qualified dividends. Qualified dividends are taxed at either 0, 15, or 20%. Non-qualified dividends can be taxed as income at rates up to 37%, depending on what your income level is and your tax bracket. So to be a qualified dividend, the payout must be made by a U.S. company or a foreign company that trades in the U.S. or has a tax treaty with the U.S. So that part is simple enough to understand. Also, the dividend must be a regular dividend and not capital gains distributions, dividends from tax-exempt organizations, or payments in lieu of dividends. So there's more to it than just this on being a qualified versus non-qualified dividend, but this is one of the major components. So with all that being said, this is why it can make sense to build a dividend portfolio inside of a Roth IRA later in life. So what a lot of people are doing, so all the younger listeners out there or the younger viewers, a lot of people focus on growth because growth can compound and it can compound over time. So what a lot of investors do is they invest in something that's like an S&P 500 or a VTI total stock market fund. They let that grow for decades, right? 10, 20 years. And then once they get a little bit closer to retirement age, they then sell that, buy dividend stocks, and then they can live off the income within that Roth IRA, right? So if you're going to go this route, you need to think really long and hard about building a dividend portfolio earlier or later in life, and if you even want those dividends in the first place. So just to give you a quick conclusion, I personally have my dividends in a SEP IRA. I'm happy investing in some dividends. I also have SCHD sitting in my taxable portfolio. That's just to kind of balance out my heavy position in VTI and a couple different other small cap positions and international positions. But I'm happy to hold them. I've been holding them for a long time. So dividends can be a great way to earn passive income, but this all depends on your investment goals. Remember, this is just my personal experience and objectives. So there are high-yielding dividend payers that could provide a level of income in the future, but if you're young, you may want to focus on growth in the beginning. Thank you so much for watching. Make sure to hit the subscribe button with the bell to be notified of all our future videos.